Welcome to the Bandido Forex Masterclass. Today, we're answering one of the most fundamental questions in trading. What is a pip? A pip, which stands for percentage in point, is the smallest price move that an exchange rate can make based on market convention. It is the standard unit of measure used by traders to express the change in value between two currencies. Most currency pairs are priced to 4 decimal places. For these pairs, 1 pip is a movement in the 4th decimal digit. For example, if the EUR/USD moves from 1.0850 to 1.0851, that 0.0001 rise is a 1 pip move. If the price moves to 1.0860, that's a 10 pip increase. It sounds small, but in the world of Forex, pips add up fast. However, not all currency pairs are measured the same way. This is especially true for pairs involving the Japanese yen. For yen-based pairs, a pip is the 2nd decimal place instead of the 4th. So, if the USD/JPY moves from 150.25 to 150.26, that is exactly 1 pip. Simple, right? You might also see a 5th decimal place on your platform. These are known as pipettes or fractional pips. 1 pipette is 1/10 of a pip. They allow for even more precise pricing in high liquidity markets. Why do traders obsess over pips? Because they are the foundation for calculating your profit and loss. We use pips to set our stop loss and take profit levels, ensuring we manage our risk effectively on every trade. The value of a pip depends on your lot size, but the goal is always the same: capture pips while protecting your capital. Mastering the concept of pips is your first step toward professional trading. Stay focused and keep learning. This is Bandido Forex Masterclass. Learn smart, trade disciplined, and always manage your risk.